Real estate is in full-blown crash mode, with office property prices down 30% and yet to reach a bottom. Real estate stocks are down 10% over the last year, second only to utilities, and the sell-off is so bad, the 5-year return on REITs is just 7.7%, by far the worst sector for stocks. But that could be your opportunity as an investor. We see in this 15-year breakdown of stock sectors by return after a similar real estate apocalypse in 2008, real estate stocks produced a 124% return over the next 4 years, more than doubling in price. Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us. All you out there in the nation know I got my start as a real estate analyst, so many years ago, and real estate will always have a special place in my portfolio. Now that bounce in real estate prices this time around could start within the next 6 months, so I wanted to get you ready with what to watch with real estate stocks and the stocks that could outperform. Don't forget to join the Let's Talk Money community by tapping that subscribe button so you don't miss a single episode. Make sure you check out tomorrow's video, the dividend aristocrats with the fastest dividend growth, stocks with more than 25 years of increasing dividend payments. Before that, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Now back to our main topic though, and as excited as I am about the coming opportunity in real estate, there is no amount of lipstick we can put on this pig to pretty it up. Here we see in data from the National Association of REITs, those real estate investment trusts that trade like stocks, that REITs plunged 25% last year. The worst was in office property with a 37% drop, but no segment was safe, with double-digit losses in nearly every type of real estate stock. And against a strong stock market return of 16% so far this year for S&P 500 stocks, REITs have fallen even further behind. The NAREIT All Equity REIT Index is up just 1.5% so far this year, with 6 property types down again, including a 7.5% loss on office REITs. That takes the 2-year loss on office property to 42%. Now, some individual examples here include Extra Space Storage, ticker EXR. Storage property REITs were the runaway winners of 2021, but EXR has now lost over 44% from its peak. Infrastructure REITs like Crown Castle, ticker CCI, are supposed to be safe from the economy, but shares are now down 53% from its peak in 2021. And hardest hit here, shares of Medical Properties Trust, ticker MPW, are now down 74% over the last 2 years, and the dividend was cut last month. So I want to walk through why real estate has dropped so much, the big picture problems, as well as challenges in specific property types. We'll look at the long-term returns on real estate stocks, and then why I expect that bounce to begin within 6 months. I'm going to show you which stocks I'm watching, as well as which I'm buying. And of course, the biggest challenge to real estate has been the Fed's fastest interest rate hikes in 40 years. This chart needs updated with 2 more increases, but you can see in less than a year and a half, the Fed has raised interest rates from 0 to 5.5%, the fastest pace it's done that in more than 4 decades. Now, to be fair, it wasn't just the Fed. Property prices seen here in Federal Reserve data surged on near zero interest rates after the pandemic as buyers jumped in on that free money to buy real estate property. But now that increase in interest rates has hit commercial property in 2 critical ways. First is that with those higher borrowing costs, it means property is just less profitable after paying that interest expense. Buyers just aren't willing to pay as much, and those prices have come down. Also though, and this is something that most investors don't understand, is that most loans for commercial property are interest only. That means the borrower only has to pay those interest payments and then refinances the loan again after 5 or 10 years after the loan is due. With those loans now being refinanced at much higher rates, from near zero all the way up to 7 and 8%, then a lot of owners are just finding that the property isn't profitable, and they're letting those go back to the bank. Banks are selling at fire sale prices just to get those loans off their books and forcing even lower valuations. Combine this then with property-specific problems, and you've got a crisis in some parts of the market. More than 1/3 of Americans are still working from home as of last year versus just 24% pre-pandemic. Upwork estimates that 22% of the workforce will be full-time work from home by 2025, with as much as half with a hybrid home and office option. That has driven office vacancy to as high as 30% in some cities, and vacancy is 17% nationwide, its highest ever. Now, in medical properties, the reimbursement rate from government programs just hasn't kept up with inflation, and hospitals are already struggling under a staffing shortage that has pushed up wages. Hospitals in rural areas are closing their doors, and that's all flowing down to the property owners like MPW and Omega. But against this, real estate has still produced a 7% annual return over the last decade and helps to buffer your portfolio against a stock crash. And that bounce coming in the next few years could boost the returns on a real estate investment trust to be some of your best stocks. When that bounce begins is largely going to depend on rate cuts, not necessarily when the Fed cuts rates or starts cutting rates, but when the market suspects they're close to that point. For that, we can go to the CME Fed Watch tool. It shows market expectations for interest rates at each of the Fed meetings. And we can scroll down here. If we scroll down and go to this probabilities tab, we can scroll down, increase this a little bit so you can see it here. And this shows the meeting probabilities for each meeting out more than a year. And you can see in blue here is the current target rate for the federal funds rate for the Federal Reserve, 525 to 550. That is 5.25% to 5.5%. Now you can see here that the market expectations are for no more interest rate increases all this year and even into next year, even into as late as July of next year. Then the market does expect the Fed will start cutting interest rates in July of next year. I believe it's going to be even sooner than that, maybe even May or June of next year. And then we get a pretty aggressive rate cut schedule, cutting at least 3 times by the end of the year. Now, a few interest rate cuts are not going to be the miracle cure for real estate because the rates are still going to be relatively high compared to where they've been in the past, but it will be supportive enough that prices are going to stop falling, and that's going to bring out the investors to snap up those deals. We're already seeing hedge funds and private equity raise money to invest next year. Cohen & Steers is aiming to raise more than $2.5 billion for a fund, and private equity firms are estimated to hold as much as $145 billion waiting to invest. And since the market is forward-looking, always trying to be ahead of that next catalyst that turns things around, we could start seeing a rebound in real estate stocks by the first few months of next year. So if we are expecting interest rate cuts by June or July of next year, you take maybe 5-6 months off of that, and that's when that rebound could start in real estate stocks. Now, I want to show you some of the stocks to watch for this real estate rebound, and one of the best resources you can use here is the NAREIT website. Again, this is the National Association of REITs. We're going to go to REIT data here up in the top, and then REIT market data first. Here, if we click on this REIT Watch, you're going to find monthly updated data for all real estate stocks. So we can click on August 2023 here. And there are almost 30 pages here of indicators and charts. I like to scroll all the way down to about page 30 is what it usually is. Here you're going to find each property type broken apart. So we start here with office space, then go to industrials. You're going to find the REITs in each, the REIT stocks, real estate stocks in each with their stats like funds from operations, that critical FFO measure. You're going to find the price to FFO valuation, FFO growth, so funds from operations growth, and the payout ratio. This is a great way to get a sense of which REITs and which property type are outperforming, which are inexpensive, and which ones you might want to do some more research on. Some individual REITs to watch here could include Crown Castle, ticker CCI. This is an infrastructure REIT of cell phone towers. It's smaller than the leader American Tower and is expected to post negative FFO growth, so negative growth in funds from operations of about 3% this year, but it's also only paying out 81% of its FFO, so 81% of its funds from operations paid out to satisfy the dividend versus 112% payout ratio for AMT. So I think CCI here has the more sustainable dividend. It's also cheaper at 14 times on a price to FFO basis versus 19 times for AMT. Here within retail, Realty Income, ticker O, is the most popular REIT because of those monthly dividends. The yield here is a decent 5.7%, and it's only paying out about 71% of its FFO, so it is sustainable there and should continue to grow that dividend. Dividend growth has been fairly weak and probably won't go up more than 2 or 3% a year because of that weakness in traditional retail, but it's still going to be a good long-term payer. And of course, we've got healthcare with Medical Properties Trust, ticker MPW. Now, this 138% FFO payout ratio, this is before the dividend cut last month. It is now paying out about 38% of its funds from operations to cover that 60 cents annual dividend. So definitely sustainable from here. That's going to free up a lot of cash flow for operations as well. FFO growth isn't great here at just 2.7% this year, but it's hard to beat that valuation at just 6.5 times on a price to FFO basis. That is very low, even compared to some of these other healthcare REITs that have gone down as well. I own the shares. I'm going to continue to hold these shares. The company is dealing with a very negative environment for those healthcare operators right now with hospitals closing right and left, but this is the nation's largest owner of hospital real estate. So I think it will survive and get through this period. Click on the link below to get your free weekly newsletter with all the stock market news, trends, and stocks you need to see. Or click on the video to the right for the 5 monthly dividend stocks with the fastest dividend growth. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.